Hello, good afternoon and welcome to MF Corner on CNBC-TV18. I'm Vinnii Motiwala and today what we're going to be discussing is very interesting for investors, especially who are looking for low-risk mutual fund options, but still want better returns. We always want better returns than traditional savings that we see in. So there are three categories that we're going to talk about today. That's equity savings, arbitrage funds and income plus arbitrage funds. Each of these funds come with their own risk, return profile, tax treatment and ideal investment horizons that are there. What is the best for you? So which one should you be choosing? To discuss all of this, and especially in a volatile market, what should you be looking at? To discuss this in detail with us, we have Raghav Iyengar, who's the CEO at 361 Asset, joining in with us. Raghav, good afternoon. And thank you so much, for joining in with us on the show.
Thank you.
Because this is such a time, everyone wants to know what they should be doing with their investments.
It's a very difficult question.
What and where you should be looking at, Raghav. Raghav, that's what is our job, and that's why we have you here to explain us that what we should be doing. Like I was saying, three types, right? Equity saving fund,
right,
arbitrage fund, and income plus arbitrage fund.
Yeah.
Now that's become the new trend.
Yep.
But I want to know, just for basics and starting for our viewers as well, what is the difference between all these three?
Okay, so let's just go back a step back before this, Vinnii. I think, as you know, mutual funds are largely four categories. Yeah. So you have the equity funds, which is the popular category. Everyone knows it, everyone loves it. Then you have debt funds, which are also great. They invest in debt instruments. You have hybrids, which is a mix of two. And then you have the other special funds like gold, silver, etc. Now, what the equity arbitrage fund and equity savings funds are part of the hybrid category, which is that they invest in a mixture of debt and equity instruments. So the arbitrage fund is a very simple fund. It's basically, it takes, there is a cash market, which we all look at, and there's a futures market, which is also very, very vibrant, right? And what the fund manager, what the scheme does is buys in the cash market, sells in the futures market, the same stock. There's a small price difference that happens, and it captures that price difference. So that is called arbitrage, but because they are categorized as equity funds, Vinnii, they are given equity taxation.
Okay.
So your post-tax returns are much, much better than, say, other comparable instruments. So they are reasonably stable. The second category is, of course, equity savings. Yeah. Now, this is an interesting one because they link three assets. They have regular equity, then you have arbitrage, and you have debt. Yeah. So they are like moderately risky, but also in a market like this today, which is a bit volatile, which is a bit choppy, they're great places. The other one, which is the income plus arbitrage FOF, is a recent baby in the market. Little bit of the money, about 36% to 45% is typically kept in arbitrage, and the balance is kept in income funds, which are basically debt funds. So in some sense, they are a combination of arbitrage and debt. So again, because they are FOFs and they give you very good tax treatment, etc., they are a great category today. That's just come up there.
Okay, great. And that's really picked up pace because everyone wants to know a lot about that. But, obviously, we know some of the risks that exist, right? Like the credit risk that is there or some of these obvious risks that are there. But how does it work with all of this as well? Which are the other risks that we are keeping an eye out on? And overall, how should we be factoring all this in our asset allocation overall as well, in terms of specifically your risk and return? So asset allocation will become important then.
So I'll answer the second one first, Vinnii. So arbitrage is a great place if you have short-term money. So they do much better because, as I said, the returns are reasonably stable. You're doing something, you're not taking any directional calls here. So in that sense, if you have, let's say, and because they categorize themselves as equity funds, the taxation is very, very beneficial to the investor. Okay. So if you have, let's say, short-term money, 1 year, 2 year money, you don't know what to do with it, I think it's a nice place to think of parking it. Equity savings funds are in people for, let's say, moderate return investors, because they will have a certain amount of arbitrage plus open equity or directional equity. Okay. And obviously a large part of it sitting in fixed income. So fixed income, as you know, acts as a bit of a cushion in volatile markets. And the last one, of course, is income plus arbitrage, which is pretty similar to arbitrage, but has an element of fixed income also attached to it. So again, in terms of predictability of returns, I think arbitrage and income plus arbitrage FOFs are very, very similar. Okay. And of course, equity savings are a slightly lower riskier version of normal equity funds.
Raghav, my point is that what is the return in all of this? I could just think like, okay, what is the return for equity savings, arbitrage, and what is the expectation normally that is there, right? If you're seeing moderate risk means then moderate return is what we're
It is. So I don't think, Vinnii, one thing investors must understand is that these are not, these are more, how do I say, for conservative investors or for investors who have a slightly shorter duration.
Okay.
You're not really trying to double your money in these funds.
Okay.
These are not meant for very aggressive investors. So they have a certain function. They are great from perspective of parking money or for risk-averse investors. They're just an alternative investment option. So I don't think you should really look at the return and put money in here.
Okay.
So if somebody is really aggressive and wants to really keep money and is able to take risk on it, then obviously there are better options than these three.
These three options,
Yeah.
absolutely. Okay, what sort of market scenarios can I look at such funds? At what point of time, this is actually, okay, it's a better bet than taking more riskier bets right now. What sort of investors or what volatility, when it's too volatile, is it good to look at these funds, or when the market is stable, would it be better to enter these funds?
So I think arbitrage obviously it does really well in terms of volatility, because it's able to capture that spread quite well, right? And it's a pretty much an evergreen category. You can put money any points of time. Of course, arbitrage rates have been coming off a bit, but that's a different topic. Income plus FOF is a great place if you feel interest rates are coming down. So if you go back and see the recent returns of many of these FOFs will be very, very good, because interest rates have come down because of a lot of things that have been happening to the fixed income markets. And of course, equity savings funds, as I said, will give you some amount of directional equity.
Okay.
But again, ideal for some time in a volatile market where you're not sure where it's trending. But at the same time, you want to participate in some form of equity, but not take that full equity risk. I think equity savings does a very, very good job there.
Okay. And are these funds actually, or does it make sense if someone has a long-term kind of a goal? If they're investing either for some kids' education or for kids, or if someone is investing for retirement, then does it make sense to have any of this in my portfolio, or would it just be better to look at...
They're great from a withdrawal perspective.
Okay.
So let's say hypothetically you are saving up for your retirement 10 years.
So something like for an SWP.
SWP, yeah. Because as I said, the commonality of all these three funds is that, especially arbitrage and income plus FOF, is that there is some level of stability and predictability.
Okay.
And that works very well in an SWP scenario, whether it's for your child's education or retirement or anything.
Okay. So
but are they accumulation investments? I don't think so.
Okay, yeah.
So maybe you should save your money once you get to a particular goal. And
then maybe you can.
Then maybe you should think about this.
Okay, that's interesting to know. Okay, how sustainable do you think these returns are from arbitrage, income plus arbitrage funds? The spreads, do you see them narrowing? How do they move normally? How should we be judging these sorts of funds?
See, arbitrage spreads largely have come off a bit. One is largely there's a lot of participation. Institutional participation is heavy.
Yeah.
In the Indian mutual fund space itself, that category has almost tripled in size in the recent past.
Yeah.
So it's just a lot of money there, plus obviously other institutions. The other thing, of course, is level of volatility makes a lot of difference. That tends to make the arbitrage go up and down. But one thing that I have noticed, Vinnii, with arbitrage is that they pretty much synchronize with your short-term interest rates. So they're in and around those rates. I think the advantage of arbitrage is that it gives you the whole tax advantage because they're categorized as equity funds. So your post-tax returns are much, much more efficient as compared to other instruments. Income plus FOF, as I said, it does really well in a falling interest rate scenario.
So right now is the good time?
Yeah, now the bet is out whether interest rates are going to fall more or they stop.
Or not, yeah.
I think that's something that other smarter people will tell you. But yeah, that's the big call there. But if you are a believer that rates are going to go further down, and again, because it's categorized as an FOF, your post-tax is much better. Because if you keep money for 2 years in a fund of funds, your taxation is very, very advantageous to you.
Okay.
And as I said, equity savings is pure equity taxation. Yeah. That's just that's an easy category if you're looking to really put your feet in the water, but you're not sure of whether the temperature is correct or no. So that's a place where you can jump in.
You know, how do these funds normally work in terms of hybrid categories specifically, right? How do they optimize this portfolio risk we talk about, the risk and return over there? Is there a specific way that one, as a return for investors, they could look at something, given that, you know, there's equity or debt exposure both come into this factor as well? So how should you be looking at such a scenario in terms of risk? sort
No,
of?
one is first things first, and this is for any category, just not for this one. Please don't look at the last immediate returns.
Yeah.
They sometimes tend to confuse you because economic events have an habit of amplifying returns or subduing it.
Yeah.
And you don't know what time you're looking at. So that's number one. So first of all, you get your story together as to why are you investing in those particular instruments. As I said, these are largely these are more stable investments. So again, it depends on your time horizon. So obviously, if you have a lower time horizon, then maybe an income plus FOF, arbitrage FOF, or an arbitrage is a good place to think about. Or if you're really looking at maybe you want to put some money in equity, but you don't have a very long-term horizon, then obviously the equity savings makes a lot of sense to you. Yes.
Okay, sure. So, we've highlighted all the risks and returns and possibilities that actually come in with this as well. Low risk, moderate risk. So we've spoken about all of that. So on that note, we're actually going to sip into the short break that we have to take right now. But don't go anywhere. We'll continue this discussion forward with Raghav, and more updates we'll get in from him as well after the short break. Welcome back to MF Corner on CNBC-TV18. We still have with us Raghav, CEO at 361 Asset, and today we're discussing equity saving funds, arbitrage funds, income plus arbitrage funds. The difference between them, we spoke about that. We spoke about the risks that are there as well. But now let's understand what is it in terms of categories that we're watching out for from this, in terms of stability that comes in with this, and especially in terms of liquidity and redemption, what are we watching out for here? Raghav, that's my next point, right? In terms of liquidity, how liquid are these funds versus each other, equity saving, arbitrage and this? And in terms of redemption also, how should we be looking at it? Given that, market is so volatile, or when there's too much stress, at what point of time should you look at redeeming these funds?
So as I said, Vinnii, the arbitrage funds have done quite well in market drawdowns, because that's the whole point in them. They are very stable. And they manage this whole market drawdown plus liquidity events very, very well. So there was absolutely no problem. Equity savings obviously had a bit of directional equity. So obviously when market had a bit of a drawdown, obviously they did get affected, but no issues on liquidity at all. Income plus arbitrage actually did really well, because there's no equity directional market there at all. So actually they are for a completely different set of investors. They were actually, in some sense, they are more for debt plus investors, not really equity investors. So all these three did, in a market drawdown, they tend to do very, very well. So as I said, there must be in some part of your portfolio. So it's actually, if you are a big equity investor, you should have some money parked in any of these three categories.
How much should it be?
No, that's very individual, Vinnii. I'm not going to answer that question.
no 5%, 10%, any indication?
No, because everybody is different, right? I don't think you can put that 100 minus your age formula in any of in life, right? Yeah. So, my dad, for example, is 80 plus, and he has a reasonably large component of his money in equity, because he doesn't need the money, right? Yeah. So he can keep it away. Whereas someone who's a 30-year-old may have a lot of housing loan, may not be able to keep so much money in equity. But yeah, it's great to keep this for, let's say, emergency purposes, for money that you might need for very short term.
So it's liquid, right?
It's liquid. It's liquid. It's anti-directional to equity.
Okay.
So in the sense that if you're worried about equity markets and you're worried about volatility, I think this is the place to go to. So.
Okay. And are there any warning signs or something that I should watch out for as an investor when I'm looking at any of these funds specifically? That's like the red flag that comes in.
Yeah, I think the big one for me is that because a lot of these funds employ arbitrage strategies. Yeah. So are they consistent with their arbitrage strategies? Okay. And that's so if they say they're going to invest X amount in arbitrage, are they in and around that number? I think if they're way off that number, then I think that's something that one needs to be worried about. The second thing, of course, both these categories, especially equity savings and to some extent income plus, obviously have a fair amount of fixed income in it. So one needs to be careful as to what sort of fixed income are they buying. So if they're buying risky fixed income, may not be the best thing from an investor outcome perspective, right? You could lose capital. But yeah, these are the two big things that I could think about, Vinnii, over here. In this
okay. And how is the checklist for each of these funds different when I'm investing, right? Like you said, that don't look at just the short-term returns or go and just see my one-year return. That doesn't make sense.
Yeah.
Then what do I have to look for? Equity saving funds, maybe arbitrage and income plus arbitrage now.
So income plus arbitrage, as I said, the big investment is actually happening in fixed income. So you just need to keep looking at the fixed income part of it. What are they doing with their money, right? And it's going to invest in a set of fixed income schemes. So if they are largely fundamentally great performing schemes, they've got a good track record, no problem. Equity savings, I think the key thing to watch out for is the amount of directional equity in the portfolio. Because as per the scheme regulation, you can go 15 to 45. So obviously, if a fund has say 40% in directional equity, it's going to be more volatile, a bit more risky than some fund which has say 25%. So that's the other one that needs to think about. In arbitrage, it's pretty simple. You just need to make sure how the fund has done in terms of performance consistency. The consistency, of course, is important on all the three, but arbitrage is much more important. So you should just try and figure out how it's doing on a monthly rolling or a quarterly rolling basis. However the returns work for you. That's it.
Okay. There's one point that I want to understand. We spoke about taxations for all of this, right?
Yeah.
So I want to understand, does it in any way help in sort of tax saving sort of a thing? Does it become a good bet? If you're looking at those tax sensitive kinds of investors, would it be making sense to look at
of course. So arbitrage is actually is ideal for someone with short-term parking and is looking to actually optimize.
Short term is how short? How much are you talking about?
Ideally, even if you keep it for less than a year, your short-term capital gains tax is lower than what you would pay under normal circumstances. You keep it for more than a year, it straight away goes to 12.5%. Same thing happens in income plus arbitrage. That period instead of 1 year becomes 2 years. So obviously, if you're somebody who's very sensitive to post-tax returns in your investment, which all of us should be, in my opinion, but if you're more sensitive because you are in an income tax bracket which is very high and you're looking to optimize that, then obviously arbitrage and income plus arbitrage are great products to think about.
Raghav, what if someone already has fixed deposits, right? Like they are holding, you have something, that was the basic way of investing first, right? So when you have those fixed deposits, then how should I approach this sort? Like, because I'm already holding so much there, then how should I be looking at this?
No, so I think FDs are a very important part of your investment, right? And I think they've been given a bad name because of whatever is happening in capital markets. But I think people remember fixed deposits a lot when your capital markets or equity markets start getting risky, right? So I think first thing I like to say is please keep money in FDs. I mean, that's very critical. I know we are in an MF show, but I'm not going to make that statement today, right? Number two, in this one, obviously, it depends on what's your period of investment. So if you're somebody who can put money away for maybe 3, 4, 5 years, then I think equity savings is a great place. It's like I said, if you're between 6 months and above, or 1 year and above, I think arbitrage is a great place. Same thing with income plus, 2 years is a great place to look at it. So I think if you keep that thought in mind when you're investing, I think you're sorted.
How helpful is equity saving funds, especially in terms of diversifying my portfolio? If I'm looking at it with that sort of a way, then how should I be viewing?
So that's a great question, because nobody thinks of equity savings as a diversification tool, but actually it does diversify a lot, because you've got some money in directional equity, you've got some money obviously in arbitrage, and then you've got the rest of it sitting in debt. So actually, if you ask me, it's a very well diversified portfolio, but I would ladder it up in a very simple way. At the bottom of the ladder is arbitrage. The second step is obviously equity savings. The third step could be possibly multi-asset funds or balanced hybrid funds, as they call it, 50-50 funds, which are 50% debt, 50% equity. And the top of the ladder in terms of risk reward is possibly multi-asset, which does a lot of things, but obviously has slightly higher levels of risk. So if you can ladder out your investments the way I've said it, I think then you can plan it out that way. And hence, if you see, equity savings is the second step in the ladder. So it's actually a nice way to put money away, yes.
Okay. Raghav, how often or how should I be, reviewing this side of my portfolio as well, right? There is to manage your risk or to monitor it. Is it normally how you would say review it once a year? Or is it a different way to analyze a risk, given if I'm seeing a market correction or the swings that we see in market? How necessary is it to review these also as well?
See, I think every investor has to review his portfolio, right? I think that's fundamental rule number one, right? I think the challenge in today's world is that because everything is available pretty much at your phone, investors are over-reviewing their portfolio or not reviewing it at all, both of which are very bad for your financial health. For arbitrage, frankly, you can look at it once every 3 months is my suggestion.
Okay.
Because I think it's for shorter term papers. You
Short
just need to
time,
make
yeah.
sure that your returns are commensurate with what you're thinking about them. I think equity savings funds once in a year is more than enough. My logic for income plus arbitrage would be pretty much the same there. Nothing there.
Okay.
Yeah.
Raghav, you've given us all the answers possible and how we should be looking at these funds as well.
No, thank you, Vinnii. I think shows like this really help educate investors, and I think that's very important for us in the MF industry.
Absolutely. Thank you so much, Raghav, for joining in with us and helping us understand all these three kinds of fund and what they actually mean for us as investors and viewers. Thank you so much for tuning in to MF Corner on CNBC TV18 as always. And don't go anywhere. Last hour of trade is still left. And to take you through that, you have Closing Bell up next.